Good morning. Happy Friday. I'm sure that you've been hearing and seeing all kinds of new things about mortgages. I bet you've seen posts from every loan officer you know talking about a buy down. But what the heck is a buy down? It really is a pretty easy way to save you money for the first 2 years that you own your home. I'm positive that if you've turned on the TV or looked at the internet, you've seen that rates have climbed pretty significantly over the last few months. Even if you're still qualified to buy the home of your dreams at the current rate, the most important question we have for you is, are you comfortable with that payment? No matter how much I like you, I'm not making that monthly payment on your behalf. So ensuring that you still, have enough money to enjoy life is really important to both of us. So how do we fix that? We simply ask a seller to pay for a 2-1 temporary buy down. Here's how it works. Let's assume you're getting a loan of $250,000 and the interest rate is 6.5%. And trust me, today it probably isn't. But with those numbers, the principal and interest portion at 6.5% would be $1,580. With a 2-1 buy down, for the first year, the rate is 2% lower, or 4.5%, which lowers the principal and interest to $1,250. That's a monthly savings of $313. For the second year, the rate will be 1% lower, or 5.5. The principal and interest would be $1,420. That saves you $160 a month. At year 3, it goes to the lock rate of 6.5%. Hopefully, during that time, interest rates are going to come down again, and you'd be able to refinance into a permanent lower interest rate. Now, how do the numbers work? Where does the money come from? We simply ask the seller to pay for this when you're writing your offer. We collect the money at closing. Your savings is collected from the seller. And, instead of just asking the seller to pay generic closing costs, we ask them to pay this. How much does it cost the seller, though, Robin? Well, we're just going to add it all up. Monthly savings in year 1 comes to $3,756. Year 2, it's $1,920. So the total is $5,676. When you write the offer, you would simply ask the seller to pay that amount or more, if you can get it, towards your closing costs. If you ask for just that amount, it's probably a lower dollar amount than a lot of buyers would even be asking for, and it has a much, much bigger impact for you. Now, what happens to any money that's left over if you refinance? Do you lose it? Absolutely not. So let's say in a year the rates are down and we refinance, and we still have that full second year's money sitting into an account that we set up for you. When we pay off your current loan, we would reduce the payoff by the amount that you have left. So in theory, another $1,920. Can you see why we're all so excited about this program? It was very common, very popular 10, 15 years ago, and it kind of went out of vogue. But it's back, and it's going to help a lot of people become homeowners today. Call us today to find out how much you can save in your first few years of home ownership. Ask us any questions. And don't forget, the only stupid questions are questions that aren't asked. Have a fantastic weekend, and we hope to hear from you with, some borrowing scenarios. Have a great weekend, everybody.